Where are rates headed? You want to know something? I was talking to someone I really respect. I was talking to owner of a medium-sized IMB this weekend, and we were talking about interest rates, and I'm like, look, I believe interest rates are going to go up. And he challenged me. He goes, Ron, why would you think that? And I said, well, most reputable economists believe there's a lot of upward pressure on the long end of the rates, the long end of the rate tail. And this owner, who's really bright, says, I'm not reading that anywhere. What I'm seeing, what I'm reading, is that rates are about to go down, and they're going to go down significantly. I've talked about this before. A lot of times when we just listen, we get into the echo chamber of listening to industry participants, where we listen to NAR's economists or the MBA's economists, or we listen to Freddie Mac economists, or we listen to industry commentators and analysts. You know what? They're all good people. They're all super bright people, but they have a bit of a bias, right? They want to tell us what we want to hear, and they want to tell the industry what it wants because they're cheerleaders too. And so oftentimes, especially say the economist at NAR, gives these super rosy forecasts that have never come true. And what I believe is that we need to go outside of the echo chamber, go outside to world-class economists, leading economists, listen to what they're saying, balance out their forecasts with the ones that we read daily or the noise we read daily, and come to our own conclusions. And so today I'm going to share a LinkedIn article from over the weekend from Michael Kramer. He's the founder of Mott Capital. He's a financial market strategist and commentator. I believe he has an MBA in finance. So he's not an economist necessarily, but he's an analyst, and he's a practicing one because he has his own, his own investment company. But I love reading his stuff because oftentimes he goes, I know this isn't what you want to hear, but this is what the technicals are saying. Or I know this is what we want, but this is definitely the direction the markets are going. And what he's covered in his article, which he does a great article every weekend, he goes, look, there's a lot of pressure on rates. There's a lot of upward pressure on rates. And this mirrors other economists I trust, like Dr. Torsten Slok, a whole host of economists that just say, look, here are all the conditions that are present to put pressure on rates. Now, before I keep, I'll get off my soapbox, but some of the insights from Michael's article over the weekend, he goes, look, the Fed rate policy, we may be near the terminal level. That is a level where it's either accommodating, nor it's either QE, or it's not tightening, or it's not accommodating. It's neutral. That's the terminal level. And really, he thought, barring any type of recession, further cuts probably aren't likely, and that the easing cycle may be complete. I know this is different than what we hear every day. I get it. And he thought that this could push the long end of the curve, the 10 and 30-year treasuries, higher, not lower. And of course, if 10-year treasuries and 30-year treasuries go higher, mortgages will be that much more higher, right? And he thought that the 10-year treasury may rise to around 4.8%. That's where it's going to settle at. We know that it bounced about 5% last week. But that the 30-year rate could hit new cycle highs of 5.15%. Remember, we're carrying about 260 basis points of margin above the 10-year treasury, so that will tell you where our rates will be. And that the narrow spread between the short and long-term rates do not adequately compensate for duration risk, right? He thinks the long end could steepen dramatically if markets accept that short-term rates won't drop much, right? And so I encourage you to read his article. I encourage you to follow Michael. I encourage you to follow these economists that aren't in our industry. You'll really get some insights. Now, you may disagree. And by the way, rates may go down because it's a highly volatile world. Anything can happen, and nobody knows what's going to happen. I mean, we can have all these things that Michael's saying or Dr. Torsten Slok is saying, and the Fed could come in and buy a bunch of paper and push rates down. All sorts of things could happen. But it's good to be aware of both sides of the equation. Hear everyone's argument. Quickly, I'll show you just so you get the sense. I'll show you, here is Michael's article from the weekend. It's really good stuff, by the way. He's very technical, and he's very easy to understand, unlike some analysts and economists. You can't understand a word they're saying, or it's super complicated. You need to have a PhD to track them. He's super easy to use. And once again, I'm not denigrating any of the people in our real estate or mortgage industry. I'm just saying let's balance it out with people that don't have the vested interest in the direction, right? And so, for the people I follow, unfortunately, I think there's some upward pressure on rates. But you make up your own mind. You create your own strategy. You create the advice that you give to your clients. That's all we can be, is well-informed, have an educated opinion, and advise our clients the best we can. I did a post on this in LinkedIn today. I do posts on articles on this frequently. I do 2 or 3 posts a day, trying to add value, trying to give information, letting you decide. If you get a chance, check me out on LinkedIn especially. And I hope you have a great day. I appreciate you giving me a few minutes of your time. I look forward to talking to you again soon. Thanks.